We're live. 10. Good morning and welcome to The Money Movement, a show where we explore the issues and ideas driving this brave new world of digital currency and blockchains. Really excited about this special edition we're having this morning. We're really privileged to be joined by a really distinguished group of guests. Michael Kumhof from the Bank of England and also previously with the International Monetary Fund. Tommaso Mancini Grifoli, a leading researcher and publisher and thought leader at the IMF, and David Zou, who is one of the more preeminent economists in the fintech world in China and has published extensively and very thoughtfully about China's new full reserve digital currency, DCEP. So today, we're really trying to continue some of these global macro themes. And I think there are a lot of ideas that we're trying to synthesize here. There are ideas about what's happening in the current global economic crisis. What is this doing to the role of major reserve currencies? What impact could this have on the banking sector? What can we learn from prior crises, the Great Depression, and alternative models for how the financial system might be constructed, and then synthesizing that with the here and the now of breakthroughs in technology, digital currency, stablecoins, and imagining if we can see the construction of a new international monetary system and what that might look like. So kicking this off with our first guest, I'd like to welcome Michael Kumhof, who is Senior Research Advisor in the Research Hub at the Bank of England. Welcome, Michael. And Michael is not yet with us, so stay tuned. So I'll share a little bit about Michael and his work as he's joining us here. Michael is someone who, working with the IMF after the financial crisis, published a really key piece of work, which was centered around looking back at the Great Depression and a set of economic ideas that were being proposed by leading economists. And we touched on this in an earlier episode of The Money Movement, but this was called the Chicago Plan. And one of the preeminent economists, Irving Fisher from the University of Chicago, put forward a plan for what we would call full reserve banking or full reserve money. And the idea was that we had this situation in the Great Depression where you had banks who were lending based on deposits that they had, but they were lending out way more than they actually had deposited, and that led to very significant risk taking, which led to runs on the bank, and this sort of cascading set of bank failures. There's a long history of that, and these economists really put forward an idea, which was, could we separate the function of the sort of medium of exchange, the kind of this piece of the banking sector, which is focused on making money work, a payment system, and the actual the currency itself, from this sort of credit function of banks, from underwriting risk and issuing credit. And if you could separate those and you could build a safer model for money that was based on full reserve, that you could potentially have a dramatically safer financial system. So that was the essence of the plan. And after the financial crisis, Michael, who will join us here momentarily, published a really fantastic paper, which we've linked to in our show notes and show promotion, which was really focused on the Chicago Plan revisited, and in particular, kind of looking at the that history and looking at the United States economy in particular, and saying, had we applied this, what kind of alternative economic reality would we have seen? Would we have seen a stronger set of economic output, less boom and bust, shorter recessions, fewer cycles, less debt? And he strongly concludes that that is the case. So we're going to hear Michael talking about that. And but if he's running late, we're gonna probably start with another guest. And so I'm going to invite another guest in now, which is David Zou. So David Zou is joining us today. He is the chief economist for Wanxiang Blockchain, and David is really one of the preeminent fintech economists in China, and has published extensively on the Chinese digital currency. He was also chief economist for Bitmain, and has likewise worked within the banking sector there, and has really looked closely at the implications of what I think is the most significant scale full reserve banking model that we're seeing, and it is based on a digital currency, which is the DCEP, Chinese digital currency. One moment. We are waiting for people to connect in right now. I really apologize about this. We are going to we're going to pause the show, and we'll get back online in 5 minutes. Really apologize. Welcome back to the Money Movement. We are going to kick off from the top here. We're very, very excited, as discussed, to have with us our first guest, Michael Kumhof, who is a Senior Research Advisor in the Research Hub at the Bank of England. Welcome, Michael.
Thanks for having me.
Appreciate you joining very much. I think it would be great just to start. I mean, you've done some very interesting work in this whole topic of full reserve banking, the Chicago plan, which we've touched on before on this program, and also on digital currency and potential models for central bank digital currency, which I find all interesting and perhaps not coincidental. But I thought it'd be helpful just to kick things off to have you kind of take us back to the 1930s for a moment. Take us back to Irving Fisher's 4 principles of 100% money. This idea that we could see fewer and shorter recessions, less public debt, less private debt, no bank runs, a much different inflation situation, and you later argued higher output. So maybe just take us back to that set of ideas, and we can kind of help the audience understand that.
Okay, very briefly, I will tell you about how I got back to that set of ideas myself. They started when I was working at the IMF. And around 2006, I was getting very concerned about what I was reading about what was happening in the US financial sector. I had previously worked with Barclays for 5 years. And at that point, I started reading a lot about monetary systems and the history of monetary systems. And what I came across as a key reference is a very short booklet by Irving Fisher, 100% Money and the Public Debt, which I then proceeded to model, because that is my full-time job, is basically to devise macroeconomic models that help us to think through macroeconomic mechanisms. And so basically the key notion in that work by Fisher and his contemporaries was that the Great Depression, one of the key problems was a shortage of a medium of exchange. He called it the circulating medium. The fact that banks create that medium of exchange by making loans, and that is how the majority of the medium of exchange is created, especially today, but even at that time. And the idea that this could create financial instability, first in an upturn, because banks can make new loans by creating new deposits without having to worry about attracting new deposits from somebody else first. That can lead to lending booms, or can make lending booms easier to kick off by the banking system. And then in a downturn, bank loans start to default. Banks start to lend less because they're more worried about the risk. Both of that destroys bank deposits, and the destruction of bank deposits is the destruction of the medium of exchange, precisely at the time when they are needed the most. That was one of the ideas of Fisher, but the other idea was that in order to create the money that we use, and this is more true than ever, we need debt, because the banks can only create money by somebody going into more debt, getting a loan, so that the proceeds of the loan can be credited to his or her deposit account, meaning that if we want to create enough liquidity, it has a flip side, and that flip side is increasing debt. So the Chicago plan idea that Fisher laid out so well in that short booklet consists of the separation of the monetary and credit functions of the banking system. In that system, the central bank would be the sole creator of money, and the banks would only be the intermediaries of money. They could no longer create deposits by making loans, but instead would have to attract sufficient deposits of money first before lending them out. And that plan, I should emphasize, was an idea of who were, in essence, the founders of the Chicago School of Economics.
Yes.
They were very laissez-faire for industry, but at least in those days, they found that a prerequisite for efficient laissez-faire in industry was that when it comes to money creation, there should not be that kind of laissez-faire. this should be handled by a central bank, by the authorities.
Right.
And I was able then to basically confirm Fisher's conclusions, the ones that you already outlined, a better ability to handle financial cycles, financial crises, less debt, because when you issue money under the Chicago Plan via the central bank, you issue it basically as a token that signifies this is something you can purchase something with, but there's no corresponding debt. So lower debt. And the output gains that I came up with had something to do with the fact that this would be an economy where everybody would be less leveraged, far less leveraged than today, including governments. And lower leverage typically implies a lower real interest rate, and a lower real interest rate implies more capital accumulation and more economic growth.
Right. So I think that's a fantastic summary. Thank you. I think it's really noteworthy, these ideas for a safer, if you will, and ultimately more effective financial system emerge following crises. This has obviously emerged in the mid-1930s. You're revisiting these ideas, shortly after the financial crisis, and I think an ongoing European financial crisis at the time. And, I think once again, we're now needing to look at these questions again. We're facing obviously an unprecedented amount of monetization of debt globally, but also we're still in the early days of this economic crisis. And I think, part of the underlying risk that people may be concerned about is this deeper set of solvency risks at the household level, at the level of the firm, at the level of commercial lending institutions, and ultimately even sovereigns. And we can look at each individual country in isolation, but we have this very interconnected global financial system. I saw the European banking authorities actually yesterday, published their view that they think most banks will be okay right now with their stress tests. Maybe there's going to be some that don't have quite as strong loan books. But that's, still it feels like built on rosy assumptions about whether there's cascading waves of economic downturn here. But not so much looking for you to predict the future. But I think the interesting question is, it feels like these ideas are more relevant and germane again today.
Yes, I would agree with you. Again, if you look back at Fisher, he was always saying the Great Depression is the main phenomenon was that people were perfectly able to do work, to do real physical work and be productive, but they weren't able to pay each other because they weren't able to get their hands on the medium of exchange, the circulating medium. So now today we're in a situation where, first of all, there is a risk that nobody would deny that more bank loans will go bad. And that immediately destroys, when it's written off, it destroys part of the medium of exchange. There is the risk that banks will lend less because they're nervous. Obviously, central banks are trying to steer against that, but there is that underlying risk. That also destroys the medium of exchange. There's also a third one that I am exploring in a recent paper with Chuanwei Wang from the University of Oxford, is that banks' net interest margins are very compressed because of the low interest environment that we already have. And that is further reducing banks' incentives to lend because they can't make that much money on lending.
Why lend when it's not very profitable?
Yeah. Yes, exactly. And so the question then is, how do we deal with this situation? And when you realize that the main function of bank lending is to create liquidity by means of which people can pay each other, and if you realize that banks have all these headwinds, then you can ask the question, is there any other way in which we can create this liquidity? And that's where the whole issue of public money comes into, potentially comes into the equation.
Yeah, and so I think it's a good touch point on part of the other theme that we're going to talk about here in the show today, which is these ideas of stable coins, central bank money, digital currencies. And I know you've touched on some of that in your research at the Bank of England. And we have some other guests who are going to speak to that more as well. But I think this idea of a full reserve digital money that has, the utility value of the internet, which we all now know and understand. But this idea that this digital currency must be full reserve, and it must be, backed by, or the underlying issuance based on something like government securities. We have US dollar coin, which is sort of fundamentally, based on short-term US government securities. I think in the paper you wrote for the Bank of England, you spoke about a model where, a central bank digital currency would exclusively be based on, essentially, sovereign, securities issuance.
Not sovereign securities, is literally central bank reserves, right? Which is different, because that world is one where essentially the central bank issues the money that we use, potentially via an intermediary. The Bank of England issued a discussion paper in March where it lays all that out very nicely, right. Where the central bank could be the issuer, but the private sector could provide the customer-facing account, but the account would ultimately represent a liability of the central bank, or an item on the liability side of the central bank.
Right. Right. I think part of the notion was that a commercial bank that wanted to possess, or an intermediary that wanted to purchase, in a sense, central bank, digital currency like this, there would be certain eligible assets that would be allowed to do that. You couldn't use fractional reserve commercial bank electronic money to do that, because it sort of defeats the purpose.
Yes. In fact, I've written a paper with Claire Noon, who is now at the Reserve Bank of Australia, in 2018, where we're talking about this. And this is, it has a big bearing on financial stability and the ability of the private sector to potentially run on bank deposits and into CBDC, where there are various ways of preventing that, and therefore making the financial stability side of this much safer than what people might expect. One is by having an interest-paying CBDC, where you can make it as attractive or unattractive as you want. And the other one is by basically saying, if you want to have this form of central bank money, you need to come with the central bank with an eligible asset, and that eligible asset is typically, in today's world, a government security.
Right. Right. Yeah, that makes a lot of sense. Very interesting. I think the convergence of both this digital currency world and ideas of full reserve banking and potential ways to restructure, reconstruct elements of the international monetary system are with us. What do you see in the next few years?
What I see in the next few years, when we talked a lot about the Chicago plan, we didn't really delineate it very clearly against central bank digital currency, a little bit. But let me say a few things about that, because that's critical for going forward. Is that the Chicago plan is not on the drawing board. That would be a pretty radical reform. Central bank digital currencies are now on the drawing board at a number of central banks, and the Chinese are amongst the ones that are furthest ahead, it looks like. But for example, in Europe, Sweden has looked into it very closely. Canada is looking into it very closely, et cetera, et cetera. Central bank digital currency is a world where you have the fractional reserve banking system and central bank digital currency existing side by side. Right. And that's a paper we wrote in 2016. And the intellectual history is interesting. When I wrote the Chicago plan in 2012, this was sort of like a bolt out of the blue, and people thought, what the hell are you talking about? And this is way too extreme. And then it's sort of interesting that in just a few years since then, the little cousin of the Chicago plan, which is what central bank digital currency is, right, is being debated a lot. Yeah. So you can see that sometimes the debates seem glacial to me, but I think in historical terms, it's actually pretty quick.
Yeah, I would agree. I mean, I think many of the underlying motivations for the digital currency movement, if you want to think of it that way, is, how do we build a safer financial system? And, yes. And I think that animates a lot of things as well. But well, Michael, this has been a wonderful and fascinating discussion. I really greatly appreciate you joining us on the program, and look forward to your continued research and work, and hope to stay in touch.
Yeah, thanks very much again for having me on the show.
Thank you, Michael. So I think, you know, stepping back here, obviously there's this fundamental disruption of digital money, of these new forms of medium of exchange. We have these breakthroughs of digital currency itself. We have non-sovereign digital currency. We have stable coins. We have emerging ideas for how governments or leading central banks could deal with this. There's a lot of questions being raised about what does this mean for central banks, and what does this mean in terms of the potential for new types of digital currency banks. And so joining us now to discuss all of this is Tommaso Mancini Grifoli, who is the Deputy Division Chief of the Monetary and Capital Markets Department at the International Monetary Fund. Welcome, Tommaso.
Yes, hi. Thanks very much, Jeremy. Delighted to be here.
Yes, wonderful. So, you know, you're also a prolific thinker and writer and researcher on a lot of these topics. Have enjoyed everything that you've done over the years. But you've touched on stable coins and global stable coins. You've written extensively about, you know, approaches central banks might take to this. And then I think this really critical idea that you and others at the fund have put forward for a synthetic, or what I like to call a hybrid central bank digital currency model that leads us down this path to the idea of narrow banks. And so I want to start there. You know, maybe first just help us understand, what is a narrow bank? How does it fit with this idea of full reserve money? How does it fit with this idea of digital currency?
Sure. Thanks, Jeremy. Maybe I should introduce also the concept of synthetic central bank digital currency, so that our listeners can follow more easily.
That would be fun.
So a synthetic central bank digital currency is essentially a private-public partnership where the private sector issues a liability that is used by you and I to purchase assets for payments. But that liability is fully backed with central bank reserves. And that liability is issued under license that the central bank would extend, and in exchange for the central bank to obviously supervise and regulate the business and the institution. So this is different from what people originally called central bank digital currency, which would entail the central bank issuing a liability directly to the public. So either we hold an account at the central bank, or we hold a little digital token on our wallet issued by the central bank, and we trade that. So there's a fundamental difference here because the private sector is an important player. And when we spoke to central banks about central bank digital currency, they would all say that, well, there are advantages, that there are disadvantages as well, but there are advantages. So it's interesting to consider this. But of course, it's very costly, it's very risky to the central bank, and it might deter innovation. Mm-hmm. So this private-public partnership is intended to conserve the comparative advantages of the private sector to interface with clients and innovate, and the comparative advantage of the central bank to regulate and provide trust. Now, of course, this is similar to a narrow bank because this is a specialized payment institution that issues liability that are fully backed with central bank reserves. But I would like to avoid the term narrow bank because it's so charged. This is not a narrow banking license that the central bank would issue. This is a special synthetic CBDC license that the central bank would issue, and that would have all sorts of limitations in order to avoid problems of financial stability. And I guess we'll speak about that later in the program.
Yeah, so I think it's fascinating, and it's something that we have very much gravitated to. I think in the absence of these types of charters and supervision, private sector, actors are sort of driving ahead in the space. You're familiar, obviously, with the work that we do and others. But it's moving fast, right? So we see these kind of global stablecoin arrangements. that have, reserve models, that have 100% reserve models, that are, backed by, sort of, sovereign securities typically, but it's not yet, hey, there's an account with the Federal Reserve, or there's an account with the European Central Bank, and it has a set of supervisory relationships. And I think, yes. But this idea of public-private partnership, I think, is really, really critical. And the sort of private sector in technology has shown incredible capacity for innovation and reach and distribution. And if you can marry that to the safety and soundness and the kind of supervisory rigor of leading central banks, you potentially have something quite powerful with that emerging.
Yeah, so that's precisely the idea, Jeremy. Is that we shouldn't stop. We shouldn't stop the innovation. We shouldn't rein in the innovation, but we should make sure that it happens within the confines of a regulated environment. I mean, it's great that we have new innovations in payments. We have stable coins that are backed with relatively safe assets, but there's a bunch of different stable coins that are available. It's hard for consumers to know which ones are really fully backed, which ones really offer a claim on the underlying reserves, and how liquid and safe are those reserves, and are they liquid and safe in all states of the world? It might work now, but not during a crisis. So there are all these questions that emerge, and that pose fundamental risks to users and to the safety of the financial system. And so the idea is to address those head on, to provide a regulatory environment, an equal playing field for all the innovators, but to allow them to continue to innovate on the technological front, and to allow them to continue to interface with customers, since that's what they do well. So that's very much, I mean, you described it very well. That's very much our idea. Now, there are differences, of course, as to how you might design this. And there's a debate as to whether the liability would be issued by the central bank or by the private sector. And so I think that, people used to think about central bank digital currency as something that the central bank would run entirely. That idea is kind of out the door. We've warmed up to the idea of a public-private partnership. And the question is how to design that partnership. So along the value chain, from interacting with customers to undertaking customer due diligence, screening customers essentially, to building the interface with which customers trade the tokens, to picking the technology, and that's essentially issuing the token, to conserving data, et cetera. All these steps are necessary. The question is, where do you draw the line of what the public sector does and what the private sector does? And the fundamental question is about issuance, I think, is does the public sector issue and the private sector distribute, or do we also allow the private sector to issue? And I mean, it might, and this is still up for debate. And your views would be essential for this, because I think one of the objectives is to spur innovation. And the question is, if the public sector issues the tokens and decides on the technology, how much room will there be left of the private sector to innovate? So we should have a discussion about this, how to encourage innovation.
Real discussions happening, as we speak. I think, in the absence of a specific regulatory framework, right? We've seen these sort of self-regulatory arrangements like Centre Consortium, Libra Association, other things emerging. Establishing technical standards, compliance standards, other things. And I do expect, we're going to see the issuance of these types of global stablecoins go from the kind of, low billions to maybe the tens or hundreds of billions. It's not yet at the scale of, $1 trillion of assets. But I think you can imagine whether with a public-private partnership model and new rules of the road that are put in place, or just the sort of vector that private sector actors are on right now, you can certainly see a world where there is a dramatic amount of these digital currency tokens in circulation. I'm curious to hear your view on, whether this, and it relates to the last discussion we had with Michael, was, does this gradually change the nature of banking? Is this sort of the green shoots of the Chicago plan? Does it reduce risk? Do we find that these digital currency units, combined with things like smart contracts, create new forms of lending, but on these full reserve assets. I'm very curious in your view on zoom out a few years. Does this start to change some of the fundamental both risk taking and operational dimensions of how banking works?
Yeah. So I think that, first of all, the intention here is not to rock the boat in the banking world. We have a fractional banking system that has served countries well, that has created risks and has moral hazard for sure. But we should tighten regulation in those cases, make sure regulation is applied consistently and forcefully, and not necessarily use new technologies to change what is wrong in banking, because of course that would get rid of what works well in banking, and that is maturity transformation, the extension of credit, etc. So I think that the intention is that these new schemes would be limited to retail payments, at least to start. The intention is actually to build in certain design elements so as to limit the amount of disintermediation of the banking sector, to limit the amount of deposits that might migrate from the banks to the synthetic CBDC or stablecoin providers. So this might be in the form of limits on accounts, on tokens held in these wallets. It could be in the way of increasing fees on these wallets as amounts grow. That's an idea of Binzile, I think, originally. There are all sorts of design elements that could be built in to limit the amount of disintermediation of the banking sector. And I think we should also, as revolutionary and interesting and useful as these new ideas are, we should keep in mind that the banking sector is funded essentially by wholesale funding. I mean, retail funding is a relatively small part of banking sector liabilities. It varies by country, and it varies considerably by country. But we run back of the envelope calculations based on the types of elasticities of substitution away from bank deposits, and our baseline is that there wouldn't be an enormous move of deposits away from banks towards these new systems of payments.
It's interesting. I mean, there's a lot to see evolve, obviously, with sort of stablecoin growth, and you sort of have with stablecoins, you have the ability to transact in a digital form with final settlement now with some of the new blockchain infrastructure, public blockchain infrastructure in milliseconds, with global reach, with irreversibility and very high levels of security. It's very, very attractive, even at a wholesale level, for transacting amongst corporations, amongst financial institutions, not just at the retail level, but it's fundamentally the same building blocks that are there. So it'd be interesting, to see sort of organically the innovation curve that happens in this world versus a sort of very prescriptive, designed set of rules.
No, I of course, and I understand what you mean, but that brings up the possibility or the likelihood that banks themselves will adopt a lot of these technologies and evolve themselves. This is not necessarily banks versus innovators. This is not banks versus stable coins, etc. What is good of the stablecoin world will likely be adopted by the banks relatively quickly, or by the more innovative banks at least. Yeah, and we'll see a merge between the two, and we'll probably see also a partnership between the two. In fact, in many countries where banking sector penetration is low, many of our member countries, we've seen the take-up of new digital means of payment is enormous. But in those cases, these new means of payment have enabled customers to come online, to participate in payments, and then slowly they migrate towards banking services. And so in fact, you've seen a partnership between the payment providers and the banks. So it's not an either or discussion.
I mean, I think having watched the internet evolve over now 30 years. In particular, you have sort of these layers of public internet technology that gradually commoditize and make widely and globally accessible certain things that where there were public utilities or large private sector utilities that provided them in the past, and then they just become commodity-free services on the internet. And it strikes me that this particular technological vector is leading us towards sort of payments and settlement being the equivalent of the free video communications we're having now, or the ability to share content and data widely with anyone without intermediaries. So I can see that future, and then that relationship between that ubiquitous payment and settlement infrastructure and let's just call it the risk-taking side of the financial system and how those work. A lot of open questions. Well, Tommaso, this has been a really wonderful conversation. It was really nice to see you and appreciate you joining the Money Movement here today.
It's a pleasure, and congratulations on putting this show together. I should just end by saying that, of course, my views, these were my personal views and didn't necessarily represent the views of the fund or its executive board. But it's really been a pleasure to participate, Jeremy. Thanks very much.
Thank you, Tommaso. Yeah, we'll see you soon.
Very good. Bye-bye.
Excellent. Well, lots of talk about these major themes around central bank digital currency, stable coins, full reserve money, etc. But we have real world implementations now today. On the one hand, we have real world implementations of models like US dollar coin, which is growing rapidly and which has a governance model around it, which is one of these emerging stablecoin arrangements, but probably one of the largest laboratories for these models is happening in China. And in China, of course, many people are aware of the announcement and now the gradual rollout of the Chinese digital currency, the digital currency electronic payment system. This is a huge experiment. It's one of the most advanced experiments in advanced economies in the world. It has, in my view, deeply significant implications for the future of the international monetary system, and not just around models that other people might learn from, but the projection of the Chinese economy and the relationship between firms and nations and the Chinese economy. So really deep and significant implications. And I'm really pleased to be joined here by Associate Research Fellow for the People's Bank of China and Chief Economist at Wanxiang Blockchain, Dr. Chuanwei David Zou. Welcome, David.
Hi, morning, Jeremy. Thanks for inviting.
Yeah, it's very kind of you to join us today. Appreciate it very, very much. I think maybe to start, you've done much broader work on fintech in China. And you've been obviously in this blockchain space as a chief economist in your current role and previously with Bitmain, which is one of the very largest companies in the blockchain space. And that early work as well, led you to an important national prize in China. So you've been following the breakthroughs in fintech in China for some time, which, as we all know, far exceed the adoption of fintech in really any other part of the world. And so your perspective obviously is tremendous. With all that in mind, I think it'd be great if we could just start for our audience with just a basic overview of the Chinese DCEP, the Chinese central bank digital currency, its basic setup, its basic function.
Okay, yeah. So the digital currency in China is called DCEP. It's short for Digital Currency Electronic Payment. So the Central Bank of China has been studying this issue for about 6 years. And so as far as I know, it's far beyond the prototype stage. Now it's under experiment in several cities in China and in the retail use case. But China is still working on to finalize its DCP plan. So it has no committed timetable and for when DCP will be fully implemented. But as far as from the discussion of the senior leaders of the central bank, So it's very clear to see what this DCEP looks like. So basically, it's a new form of M0, just money base.
M0.
It's the liability. It's the liability of the central bank, but it's backed by 100% by deposit reserve, and it pays no interest. And the issuance and the redemption of DCEP will have no impact on the amount of central bank money. So if you look at the monetary policy, the issuance and the redemption of DCEP is neutral. Yeah. And the circulation of the DCEP follow the so-called two-tiered system of central bank and the commercial banks. That means it has the wholesale layer and then the retail layer. So first, the central bank, the PBOC, Central Bank of China will issue the DCEP to commercial banks in a wholesale approach. And then commercial banks will distribute DCEP to the public for retail use. And DCEP is centrally managed. It's not like Libra or other stable coin. It doesn't use blockchain in the same sense as Libra. Yeah. So in the core of this DCEP plan, there will be a registration center and the certification center. So basically, the registration center will record all DCEPs and the ownership and the transactions. And it will manage the whole life cycle of the insurance, circulation, and redemption of DCEP. And the certification center will manage the KYC process. So this is central managed. But it follows the PBOC core DCEP follow the loose account coupling model. DCEP transactions almost don't relate on account. So it can circulate as easily as cash. So this is a very tricky point. It's very important for us to understand this point, how it is related to blockchain and other blockchain-based central bank digital currency. So because it is central managed, so it doesn't rely on distributed ledger technology. But if you look at the key feature of the DCEP, it's essentially similar to a token inside a blockchain.
Right.
For example, it has no double spending, and security and transferability, divisibility, and anonymity. Yeah. So it's very similar to a token inside a blockchain, but it doesn't rely on a blockchain.
It's using some of the same underlying technical primitives of cryptocurrency to achieve that cash-like usage and security and privacy. So it is in some ways a cryptocurrency. It's just a centralized cryptocurrency. As opposed to built on a decentralized network. One of the things I wanted to ask you about in this is, as you've heard on the program today, we're really interested in these full reserve models, and the nature of the Chinese digital currency is it is a full reserve model.
Yeah, it's full reserve.
And it's very different than traditional electronic money in some respects. And I'm interested in your perspective on what the implications are for this in a variety of areas, including monetary policy transmission, how it interacts with commercial bank deposits, and then how does that translate to broader benefits for society and the economy?
Okay, so there are actually two meanings of fully reserve. For example, for DCEP, the full reserve means the ratio between DCEP to the deposit reserve. That's on the balance sheet of the central bank. So that's how DCEP has no impact on the amount of central bank money.
Right.
The other meaning of full reserve is through the narrow banking and design. So that in that scenario, it means the ratio between the deposit and the deposit reserve. So for DCEP is a different kind of full reserve, actually. Basically, it's a new kind of cash. It's a digital form of cash.
Right.
So people will transfer or move some of the money from bank deposit into this new DCEP. And basically, it means that people will have a higher preference for cash. That's it. Yeah. But for now, cash includes both physical form and digital form. And in this process, it will lead to monetary contraction. That means bank deposit will fall, and M0 will rise. And if you look at the monetary multiplier, it will fall too. So this will have some, and this will impact the funding source of banks, because with the DCP, bank will rely more on wholesale funding rather than retail banking, and so the funding cost will rise.
Right.
So I think the Chinese Central Bank has taken this factor into considerations. They will use some monetary policy to neutralize or mitigate the contractory effect of the DCEP. And for the benefit for the society and the economies, so we can see three benefits. First, it will enhance financial inclusiveness, because it's very easy for people to have a DCEP wallet rather than a Chinese bank account, especially for foreigners. And so if foreigners and foreign companies can have DCEP wallet, and this will improve the cross-border payment. And this will,
One of the most important things I wanted to touch on, actually, which is, as we move into this world of these token-based digital currencies, obviously the potential here is that the Chinese digital currency would be broadly available on the internet and around the world. In a sense, any person or firm that has a digital wallet that's compatible with this could directly transact with the Chinese economy, directly transact with, essentially using these liabilities of the Chinese central bank. And that could be very transformative to the growing role of China in the world economy and in how trade happens with China. And so in some respects, as a technological innovation, this is sort of the synthesis of the monetary system and the internet and the reach of the internet. And I think it's quite profound because we've obviously the multilateral financial system that was built up after World War II, that was anchored in dollars and built on things like SWIFT. We're seeing new infrastructure built that goes over the internet, and that really changes the nature of economic relationships with China in a profound way.
Yes, I agree with your point. So I think this so current PBOC has no plan to test DCEP in the cross-border payment scenarios, but I think they will have this in mind, and the PBOC will use DCEP as an important part of their strategy to internationalize the renminbi. So I think in the near future, we can see that foreign people and foreign companies will have DCEP wallets, and they will transact directly with the Chinese economy. And this is how DCEP become to settle international trade. And we also look forward for the DCEP to settle cross-border financial transactions. Actually, in Shanghai, the Chinese government has experimented the use of DCEP in post-trade processing. And this will promote the status of the renminbi on the international stage. But I think the Chinese government will work very close with the foreign governments to respect their currency monetary sovereignty. So for example, if there's a very huge demand in a foreign country for the DCEP, the Chinese government will work with the foreign government to sign maybe a MOU and to lay out the DCEP infrastructure.
Well, I look forward to the day when someone can have a digital wallet and they can swap USDC for Chinese DCEP. Maybe that's not so far off in the future, but David, this has been very, very helpful, very insightful for all of us, and really connecting a lot of the dots from the these major big ideas into what's happening now on the ground in places like Shanghai and Shenzhen, and clearly eventually around the world. So once again, appreciate you joining, and very nice to see you again, and we'll see you again.
Okay. You're welcome. See you in the future. Okay.
Thank you so much, David.
Yeah. Bye-bye.
So, stepping back here again, there are incredible global changes happening right now. We're all very acutely aware of those. We are on an arc of technological change in every sector, but also on an accelerating basis in the financial sector. Driven by blockchains, digital currency. Clearly, this is going to reconstitute and restructure the international monetary system. I think maybe a couple of years ago that felt theoretical, and right now it's feeling like we are going to see that. And I think coming through this global crisis that we're in, it seems to me that this reshaping of the international monetary system will be on par with the reshaping we saw after the Great Depression and World War II. So it's going to be fascinating and exciting in many ways. And I think for us here in the money movement, we're hopeful that this leads to a better system, a system that serves us all, that brings us all people everywhere together, brings more people into the financial system, and actually drives and improves what's possible for businesses everywhere. So our next episode, just moving ahead here, is actually this Thursday, and we're going to be going from this kind of macro view, diving into the micro, quite literally. So microeconomic units of organization are sort of the other part of the economy. In other words, firms, corporations. Modern capitalism itself is built on this system of corporations, the joint stock corporation, the formation of markets for capital around those corporations, the rules, the governance, all the things that go into really the Industrial Revolution and into the 20th century, the form and substance of how we organize ourselves to work, to collaborate, and to create economic output. Now, blockchains are really introducing capabilities that allow, for the first time, a pretty deep rethinking of the nature of the corporation. What does a corporate form look like in the age of blockchains? How do people connect into these labor relationships and economic output relationships that run all around the world? Later this week, we're going to be joined by 3 guests to discuss the nature of corporations in the age of blockchains. First guest is Professor of Economics and Director of the Blockchain Innovation Hub at RMIT University, Professor Jason Potts, who's done fascinating thinking into the institutional structure of the economy and really exploring the nature of firms themselves and the interaction of blockchains with that. Some really, really exciting work happening there, which I think is describing a lot of where we see perhaps the world going. And that's going to be followed by Luis Chuanwei, who is co-founder of Aragon. Aragon is, in my view, one of the most exciting breakthrough projects in the blockchain space, creating a set of decentralized infrastructure entirely implemented with software on open public blockchains for establishing new types of corporate forms, what sometimes people refer to as DAOs, distributed autonomous organizations, but it's really much bigger than that. It's taking the building blocks of what a corporation is, the ownership, the voting, the treasury, the interaction of people committing work and receiving value, these building blocks, and it's creating a software-powered model for that is independent of any given nation state and independent of any given firm. And so it's really interesting. We're going to be excited to have Luis. And finally, Aaron Wright, who is co-founder of Open Law, which similarly is trying to take the building blocks of legal agreements, in particular with an eye towards commerce and commercial agreements, and translate those into open source libraries that are smart contracts so that you can actually take real world enforceable contracts and have those deployed, interpreted, enforced, and run on blockchains. And so part of this synthesis of these worlds of decentralization, globalization, digital currency, and the future of how companies are going to work. So very excited for that. And until our next episode, stay well, stay safe, and stay informed. Thank you very much.